Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today on our Econ show, we have a lot to talk about. We're going to break it into 5 segments. In the first segment, we're going to talk about central banks around the world, how we're continuing to see rates go up, and what does that mean for liquidity? What does that mean for, there's the restrictive nature of growth? And we're also going to touch on the current conflict or, interactions between India and China. And then we'll do a brief update in terms of what's happening in Russia, Ukraine. Then we're going to go into Fed raising rates again. But realistically, as the Fed raises rates, what does that mean for inflation? Where is inflation going from here? And really go through inflation, deflation, disinflation, because there's a lot of terms going around and we want to understand which one is which. Retail sales finally dropped. We wanted to talk about that. We thought it was going to be October. And then when it wasn't October, we said November. Happened in November. And we want to look at what are the leading indicators really telling us as we go into next year for the growth of the U.S. economy. Then we're going to go into European data where things got a bit worse in November. There's things that are going to continue to deteriorate that we want to touch on. And then the Chinese data. The Chinese data was abysmal. It was the long and short of it. And the question is, does the changing of COVID policy help, hurt, or doesn't change that? And we want to look at how that is interacting within the different pieces of that of those just what are the driving forces realistically. So now when we turn to what happened in China and India. So for those that have been following us, we've been talking a lot about Bhutan, Sikkim, and some of the interactions, because there's a long border where both sides have been building a significant amount of assets on both sides, whether it be helipads, airports, support structures, reinforced villages. There's a lot that is happening here. So when we look at where the interactions happened, it was in Tawang. So when you look at where those periods are, I think you can see here, it's to the right of Bhutan. Because remember, we've talked a lot about the Doklam Plateau, the interactions. Both sides still do not carry weapons when they go on patrol. And for obvious reasons, you're within inches of each other. So India and China troops clash on the Arunachal Pradesh mountain border. So here's that border, and then it's in the Tawang region right there. So more than 300 soldiers and approximately 150 Indian soldiers were part of the clash, with about 100 Chinese soldiers injured, 12 captured, but again later released, while a number of injuries, there about only 20 of the Indian soldiers were injured. Again, the reports vary, but it's just one of the things that we've talked about this region, and for those that have been following us since we started this YouTube channel podcast back in 2020, this was a point of contention that we've been highlighting, is the interactions between China and India, and how we thought things were going to continue to get worse as things progress, as China tries to redirect some of the anger, especially as the local economy struggles. India's economy is not doing as poorly as China. So there's a lot of facilities and companies that are leaving China to go to India, and that you were going to start to see some of that coming about. So just to give a quick synopsis, Indian and Chinese soldiers clashed on December 9th in eastern Taiwan area of India's Arunachal Pradesh state, and that borders China. And then Reuters reported December 12th, citing a statement made by the Indian Army, that Indian officials said the clashes led to only minor injuries and that both sides immediately disengaged from the area. This marks the first major scuffle between the neighboring countries since the deadly border clashes in 2020 that we talked about in Ladakh. But unlike the fighting seen 2 years ago, the latest outbreak of violence was quickly resolved before being made public and did not result in casualties. But the risk of occasional clashes will remain high as both China and India continue to deploy military equipment to their contested border, as well as build up infrastructure to defend their claims. Chinese military deployment, particularly along the Ladakh sector, has increased since the violent clash in 2020. As we've been showing sporadically as new data comes out, new satellite imagery of where things are being built up. And then when we look at what is happening in India, in Russia, Ukraine, we're not showing a map this time just because things are fairly stable. The Ukraine continues to make strides in different areas. The counterstrikes from Russia have fallen flat. So there hasn't been too much. There's been a bit more of an increase in Ukrainian controlled territory. The Ukrainians have been using anti-missile equipment more effectively. And now there are rumors that the U.S. and NATO have given the green light for Ukraine to actually strike at military equipment, military assets on the Russian side of the border, which could be a bigger escalation as we go forward. But we're coming into the heart of winter. So there actually could be an increase because the ground solidifies, easier to move equipment. So we could see an increase in additional conflict, but we'll keep you abreast of that as it comes about. Now, one of the things we want to look at, the update from the IMF shows that debt as a share of GDP fell in 2021, but it's still the most in 7 decades. Total public and private debt hit a record of $235 trillion last year, but the trend was better than 2020 when comparing to economic output. So it's important to show that this is in comparison to economic throughput. So when you look at the fact that there was a huge surge in debt that was issued by governments and companies during COVID, then you had a surge in economic growth because of that. Now you still have the debt, but you have a sizable drop in the economic capacity going forward. So we think that there is a risk of this going up, especially when it's compared to GDP, based on how things are setting up for 2023. So we do see this getting worse, and it's going to put more stress on both countries and companies that are going to struggle to not only roll this debt, because you're going to roll the debt into a higher interest rate, which is going to increase your interest expense, put more strain on the company, the country. And then at the same time, you may have to roll it in dollars. And where is the US dollar versus your local currency? Where is inflation expected? Is the local central bank raising rates, making it more expensive, which is why companies won't be able to roll, so they have to pay it off. But if you're paying off this huge slug of principal, well, what does that mean? It means that you're not investing, you're not hiring new people, you're cutting CapEx, and that's going to lead to an extended slowdown in spending, which will result in a slowdown in economic growth. So when you look at the central banks being restrictive, you can see that the current policy versus the December meeting, things have continued to tighten. And these are the big areas that really help drive what is going to happen at the emerging market level. What is the 10-year going to look like? As we've been saying from the very beginning, we expected the Fed to raise 50 basis points. You may be looking at the market saying, well, why the hell is it down? Well, it's down because even though the bond market was saying 50, there was a lot of people out there that were starting to say it was going to be 25. And so it wasn't 25, it was 50. And they showed that there's still concern of inflation. There's still concern about PCE cost. There's still concern about a lot of these inflationary drivers, which is going to keep the Fed active. And I think there was a hope that there was going to be a bigger pivot, and there wasn't, which is then creating this backdrop in terms of where the U.S. market has gone. Rates have gotten hit again, but more importantly, emerging markets, which have rallied, are finally starting to give up some of those movements. Global potential growth on gradual declining path. Global GDP growth, when you look at those movements, and again, looking at the pressure points in terms of the FX rates, in terms of dollars, in terms of just as you have a restrictive monetary policy, as we've seen in a lot of the key growth markets, or I should say demand markets from a consumer perspective, are slowing. A lot of corporations are going to slow, and that's going to put more pressure. And realistically, on this GDP path, we think it's going to be a sharper drop to the downside in the near term. But when you look at growth is inherently moving down over the coming years, and that's with a bigger debt bubble behind it, which is going to put more pressure on it, which again is why we think there's going to be that shock to the downside. Now, when you look at global and Asia composite PMI output, the indicated a quicker deterioration in business conditions in the final months of 2022. obviously excluding China, but output remained in growth territory in November. But you can see barely. One of the things that we've been talking about is that we expect to see that in contraction before year end. We talked about it in last week's segment 5. And we do believe that there's going to be that issue, which is going to wrap in India, going to wrap in the ASEAN nations, going to put pressure on some of that crude demand and really drive us a bit lower. Then the average global real monthly wage growth got hit again. And you look at global in general, and this is an issue because people were already struggling with a very limited amount of money to spend on food, to spend on things. And now you're getting it hit again in 2022. And when you look to 2023, and you have to ask yourself, do you see it getting better? I don't. I don't see it. Do I see it getting much worse? Not really. But I don't see anybody making more money around the world, given where inflation is, given where global growth is, and realistically, given where that local stimulus is. You're not getting stimulus. You're not getting that support. So then when you look at the world manufacturing PMI, again, this is inverted. So when you look at the inverted, as the central banks tighten and how they continue to tighten, when you project that forward, you get an idea of how global manufacturing PMI is going down. You're going to have that slowdown, and a lot of these emerging markets are reliant on manufacturing, raw materials, intermediate goods, which is just going to see the biggest hit, which is going to result in more unemployment because the companies are going to struggle to pay their debt. They're not going to be able to roll debt. You're going to have to fire people. That's going to put more slack in the unemployment section, in the jobs universe, which is going to pull down wages. But as wages come down, prices still remain stickier than they should, which again is going to keep inflation elevated. So then when you look at projections of central bank sheet reduction, this is the goal, is reduce the balance sheet. But in order to do that, you have to raise rates. And you want to see this shrinking, but they waited so long to do it. There was no reason to continue an easing policy in 2021. So because of that, they waited so long, they continued to pump, and they were pumping up something a bubble that no longer needed its support. But now the drawdown has to continue in order to make it usable in the foreseeable future. The number of global central bank hikes versus cuts, we've essentially paused. And if you look at where we are, there's no reason why hikes have to continue in some areas. That we will continue to get it in some of the bigger markets. The pace of cuts is going to slow. So that's why when you think about on the rolling basis in terms of hikes versus cuts, it's going to stay fairly consistent. And that's a concern because typically when you get these huge, these hikes, the cuts come fairly quickly, but we've also never had hikes to this degree. We've had cuts to this degree, but never hikes and never at such a global response. And that's why when we entered into this global experiment, our view was that it was going to end in tears and it was going to end with a lot of bad things happening. And this is really where we start to see that hit. Then when you look at that emerging market debt outstanding, you can see that the local currency debt has gone up, the foreign currency debt has gone up. And how are you going to manage that? How are you going to roll that? Can you afford it? And then when you look at the reserve operations, well, the reserves are dropping because FX reserves are in a problem. They don't have any left. In this week's Insights, we break down on Friday, some examples of how do they normally take in US dollars? How do they normally take in foreign reserves? And if you aren't getting it, how do you go out and get it? And that's a continuous issue, which is why we're seeing more problems on the local currency side, the foreign currency side, and we just really don't see that changing. If anything, it becomes a bigger problem as we go forward because the debt has been going in the wrong direction. It has to get rolled. It's going to mature, and it's going to put that weight on global growth. Global composite PMI versus Brent price. This is just showing that as things come down, realistically, you should see a softening in Brent pricing. It's not a one-to-one. It can outpace depending on where it is, but it's just trying to show that there is a certain amount of correlation to the amount of individuals that are the individual countries that are slowing, and how it just is going to reduce diesel demand, which is going to reduce crude demand, which is going to pull down some of that pricing. Developed market vacancies per unemployed. You can see that there's still a lot of tightness in the market. It's loosening, but not to the degree that people were really hoping. And then when we kind of round this out, you can see that container import volumes coming from freight waves, that November 2022 had the greatest October to November decline since 2016 at 12%, as volumes trend back to 2019. And for those that have been reading our insights and working with us since 2019, you'll know that we were not bullish in 2019. We were not bullish at the end of that year. We thought there were a lot of issues. We thought that there was an extensive slowing that was coming. And again, moving back to this level is really proving our point that global trade is slowing, manufacturing is slowing, and the end of that bullwhip, if you will, is the emerging markets. And that's where we think that there's going to be that next leg down, that bigger problem point, which we are very concerned about as we go into next year. So that's what we have for you on that segment. In the next segment, we're going to go deeper into the Fed and what's happening with inflation.